Welcome everyone. Today we are going to analyze Alibaba stock. We are going to determine what price you should pay for it with my discounted cash flow model. But before doing that, let's talk about the main risk of investing in this company. The key risk in investing in Alibaba stock is the regulatory environment in China and economic and political instability in the country. This has led to things such as the possible delisting of Alibaba and domestic policy of China towards tech companies. The Chinese tech sector has suffered strict regulations over the past years from the Chinese government, including major fines for some of Chinese tech's biggest players, including a 2.8 billion fine for Alibaba for anti-competitive business practices. You have to be okay with these risks if you want to invest in Alibaba stock. If you are okay with these risks, let's now determine what price you should pay for this stock. My discounted cash flow model allows me to determine what price I should pay for a company based on my assumptions about the future on revenue growth, net income, free cash flow, PE and price to free cash flow. So now let's make the assumptions. Starting with revenue growth, if we look at their income statement, there has been a lot of revenue growth over the last years. Over the last 10 years, they've had 42% revenue growth. Over the last 5, 28%. And last year they did 5.5%. As you can see, this year they are expected to grow 7% and next year 11%. So on my low assumptions, I went with 4%, which I think is extremely low. On my middle, 7%, which I think is what they are going to do. And on the high, 11% in case they crush it. I think 11% is probable because China is a fast-growing country. In terms of profit margin and cash flow, they have struggled recently. This last year, they had 1.5% profit margin, but this is not normal and this is a company that should have between 20 and 25%. So on my low assumptions, I went with 16, middle with 18 and high with 22. And they have a little bit more free cash flow, so this is why I went with 16, 19 and 23. Moving on to PE and price to free cash flow, the average of the stock market is around 15 to 16. So on my low assumptions, I went with 14, because it would be a company that only grows 4%. Then, if they manage to grow 11%, you should pay a premium, so I went with 18. And in the middle, I went with 16. And remember that you should not compare the PE with the company's average, but rather with the average of the stock market. Finally, the discount rate is the return you want to get each year on your investment. When you invest in an ETF, you can get 9%. So if you take the risk of investing in an individual stock, you should have a higher return. And as your assumptions get higher, your rate of return should be higher. This is why I went for 10, 12 and 15%. And as you can see, according to my discounted cash flow, Alibaba stock looks like a very good buy. So if you're comfortable investing in Chinese company, maybe this is an opportunity for you. If you are not, I would avoid investing in Alibaba stock and in any Chinese stock. Hope you guys enjoyed this analysis and I'll see you on the next one.